So how does inflation affect your insurance premium rates? Obviously, when there's inflation, you would think that everything's going to go up, and it probably does. But how does it affect insurance more or less than other things? Here's a great article from Business Insurance about how there's a 6% annual increase in consumer price index, where that's the official government index that tracks inflation. There actually may be more inflation than is built into that index. But how does it affect insurance? The spike in inflation has rippled through the insurance industry from higher construction and fleet costs. Think about it. Insurance rates are based on what the cost of claims are, right? So whatever they think the claims are going to be for an auto insurance or homeowners insurance or commercial insurance, that's what affects what the rates are. If the claims cost is going to be higher, costs more to rebuild a house, costs more to replace a car, costs more to fix damage in a commercial property, the rates are going to have to go up to account for that. Even if you have no claims, your premium payments go into the total cost of claims for all the insureds for that insurance carrier. Uncertainty has caused from the pandemic, and it could complicate recovery efforts further. For example, if part of an insurance claim is rebuilding a part of a structure that's been damaged, what if you can't get contractors to work on it? In the meantime, that insurer is paying business interruption fees. They're paying for alternate location. If a house is damaged, they're paying for somebody to live somewhere else. If a car is totaled, they're paying for the rent-a-car until the car gets replaced. Well, right now there's a backlog of orders for new cars. Sometimes you can't even buy a new car. Dealership lots are empty. So that can affect the cost. The consumer price index of let's call it 7%, may even be less than what the increased cost is for insurers to cover costs in the future. What does that mean for you as an insured? Well, if you have a good policy with a good carrier you've been with for a long time, you may want to stick with it, because even if you could flip to another company and save a little bit of money, that company might just raise you up again next year or 2 years from now when the costs go up. Your existing carrier, if they've been stable, might risk your policy at a lower risk because they know the history of your policy. Even if you're going to give loss runs to your new carrier, that doesn't tell the whole picture. Your existing carrier knows your risk coverage, they know your policy. If it's a commercial policy, they know what your business is about, and it may be more stable for them to keep your rates lower than to try to jump you up, because they already know what your risk is. The economists are even saying that inflation is occurring and it's going to go up. For insurers, having a good picture of what future claims expense is going to be is murky. It's hard for them to tell, so they have to err on the side of caution, because they're responsible for keeping their book and their financial statement healthy. They have to have so much in reserves to cover claims. And if they don't know what the claims are going to be, you have to kind of hedge in a little extra, because if they get below a certain reserve ratio, their license can get pulled. So they have to make sure they keep their reserve ratio at a higher level. So keep in mind that insurance premiums are likely to go up, if not already. Your existing carrier and your agent is a good source for finding out what the plans are and what the markets are like. Are they tight markets or loose markets for you to get coverages in the future?